Okay, let's go.
So I'm super excited for you all to be here. We're kicking off this series of weekly calls at Vyzer just to have some like weekly conversations around a specific framework or structure. So it's like it makes sense, it's quick, it's sweet, 45-minute calls. The idea is to get together, have a very dynamic conversation. This is not going to be just a presentation. This is going to be a conversation. And just for context, sort of you get an idea of how it's going to look. And I emailed, you guys all got emails about this and sort of the goal of what we're trying to create here. But essentially, we're trying to have these weekly calls to help us all be better wealth owners and investors. It's like I mentioned, not a conversation, not a presentation, it's a discussion. And we're not doing this like a typical webinar style. We're doing it just like a meeting like it. Everyone sees everyone, everyone can talk, chat, ask questions, raise hand, chime in, unmute themselves, just to have a conversation. It's really important, everything that happens here, because it is a conversation and we're not financial advisors, obviously. Anything is said here by anyone should not be considered financial advice. It's important to emphasize that. I know every GP or fund says it as a disclaimer on their slides, but I'm saying it anyway, even though this is not a fund or anything. Just make it clear, everything we say here is pure experience and insights. And so every week, the idea is to dive into sort of 10 minutes of recapping what's been happening in the markets and what is expected to happen, not in the markets from a projection of like movements, but more things that we need to be aware that are going to be announced in the coming weeks. Like next week, the Fed is going to announce, the rate cuts and so on. So those are the type of things we're going to talk about previous week, upcoming week. And then we're going to dive into a specific topic, 20, 30 minutes conversation. Every week it's going to be something else. We're going to be hosting this. Mike Arndorfer, he's also on the call here. And Mike is a good friend of mine. He's a LP investors like me, been investing on his own for the past many years. And he also coaches other people like me around investing. And so I thought it'd be really interesting to host these series with him. Some weeks we'll bring in a third person or fourth or fifth who is a professional in a specific side of the industry, an industry expert that will be able to dive into a specific topic. So next week, and we'll talk about this at the end of the call, we're going to talk about optimizing taxes. And so we're probably going to bring in someone who's a professional in taxes, because neither of us are professional tax advisors or CPAs, but like bring someone in who really understands that. So the idea is to bring in, when it makes sense, an industry expert around that. And then we'll the idea is to leave as much time as possible just to have an open discussion. That doesn't mean that during the deep dive into a topic, y'all can interrupt us or ask questions. The idea is just to leave enough time so we can have a conversation. I don't know. I like to be sort of get pushback and feedback and ideas and what we should do and not do. And either if it's about the specific topic we're diving into or something you guys want to talk about in the following week. So if any topic comes up or anything you guys want to ask or recommend, feel free to put it in the chat and we'll dive into that as well. What else from a housekeeping perspective? Like I mentioned, if you have any questions, raise your hand, type it in the chat, or just unmute yourself and chime in. And I will emphasize, it is really important for us to understand what would be interesting for everyone to dive into from a topic standpoint. So put it in the chat, or you can drop me an email afterwards, and we'll get on that as well. And as I mentioned at the beginning, for those who got in a bit late, we're recording this. We're going to be sharing it after the call anyway. So feel free to, if you need to hop off, we'll get it to you afterwards. Anything before I get started? Mike, anything I forgot that I wanted to say that you want to say before we dive into this?
Nope, sounds good.
All right, cool. Again, the idea is to do this every Thursday at 3 p.m. Eastern. We might move the timing, depend on sort of like if we feel like it's easier for them different timing or whatnot. But the idea is every Thursday at 3 p.m. We're going to do it next week and the following week, and then take a break for the holidays in the new year. But that's the idea, have a weekly cadence. All right. So as I mentioned, the first part of this, 10 minutes, let's do a quick market recap. And same as I said before, if you guys have anything that you think would be more interesting, let me know and we'll do that as well. But going over the past week, so overall, there's been slight increase in the markets over the past week. S&P, NASDAQ, Dow have all gone up a bit. ADP, which is the employment, it's a payroll company that sends out a weekly or monthly employment status, has dropped. 32,000 private sector jobs lost in November versus 47,000 added in October. That's a huge decrease. Usually this is an indicator in terms of what's going to come up tomorrow. We'll talk about this, but tomorrow they're going to releasing the NFP, which is the non-farming, forget what it stands for, but it's sorry?
Non-farm.
Yeah, non-farm payroll, that's the jobs report that everyone usually relates to. And so this is sort of an indicator to what we're going to see there as well. On the flip side, jobless claims sort of have dropped, and this is a week over week, 191 this week versus 216 from last week. So that's actually a positive indicator. In terms of sort of the 10-year yield, Treasury, so it's up 2.7% from last week, 4.1 as of when I did this, like I think an hour and a half ago. Last week was 3.99. So that's a good sign. And generally speaking, next week, like I mentioned, the FOMC is having their meeting on the 9th and 10th, and there's a 85%. This is sort of like the betting markets, 85% chance of a 25 basis points cut next week. 85%. Last week it was 77%, so it's rising. So there's obviously a good chance on that. We'll see what happens tomorrow. Now, in terms of tomorrow, we have the NFP jobs report tomorrow. That'll sort of like finalize the jobs added and unemployment rates. That'll obviously affect the Fed's decision next week. Same goes for the services PMI. I don't know if you guys want to look at that tomorrow, but I did some sort of research into this, and if you dive into it, there's metrics on that will also affect inflation pressure building and obviously also the Fed's reactions to that. But I can send more information offline for that. And obviously next week we have the FOMC meeting on the 9th and 10th where, chances are they're going to report it or decide on 25-point decrease. That's a quick rundown of the markets for the past week and what to look at next week. Anyone have any questions, insights, input, or want to add to this? Anything?
Yeah, Litan, a couple of comments. So you made a comment, and I don't know if this is what you meant or not, but with the 10-year rate up a little bit, that was good. I think most people, including me, would say that's maybe not good. But being up, it's really the 4.1, that's still in the range of where it's been. The 3.99 was a low point recently. So I don't think we're too much to expect there. And with the Fed, we'll hear something. They're in their dark period right now. Any time that, the public markets are predicting 60% or more, I think you can pretty much count that it's a lock, unless you get somebody that's, a past insider or something like that leaking a story. So the only time I would say that that's going to be different would be like, the non-farm payroll comes out and it's really hot or something, and then some past Fed governor will send out a story that says, oh, maybe this means that they aren't going to lower rates. That would be your indication that, yeah, it probably isn't going to happen, because they do try to get the market in line ahead of time. And then if it is that high, you're really, there's not that much of a market reaction from that, except it's going to be more from the comments and things like that, sort of the forward-looking comments, what the tone is, dissents, that kind of thing.
Yeah, it's a good catch, Mike. You're right. I sorry, I flipped this whole thing upside down. You're right. I agree with you on that. All right. So if there's nothing to sort of say about the market recap, we're just going to keep this market recap format for next week as well, unless you guys have any ideas or input or would want anything else. Now it's going to dive into sort of the topic of this conversation, of this call. And the topic sort of that we talked about is sort of the whole idea of asset classes. And this might sound like totally trivial to many of you, but it isn't really. And I just got an email yesterday from a private credit fund. And this is sort of the webinar they're doing, or they did today. And it's debt versus private credit. And if you ask me, isn't private credit debt or debt private? Like, it's all same thing same definition of the same, or it's different. I don't understand what this is about now. Probably if we were on the call, I would have learned more about it. But just an example of sort of like how terminology in asset class or asset allocation works or affects our decisions, because it's basically turned out of whack. I think if we look at all these reports that these different communities share about asset allocation and how other people allocate their assets, you'll see like each one of these slices has different titles for the slices and different definitions of what an asset class is. And if we're thinking about how we want to build our portfolio or think about allocation, it's really hard to do this when there's no simple framework. One of the only frameworks that is kind of standardized for the mass market is, there's a stock bonds portfolio of, let's say, 60-40, 70-30, 80-20, depending on your age and risk appetite. And that's sort of like I think the consensus across the mass market industry. But then once you get into more complex investing, like a lot of us do, then the definitions of asset classes becomes kind of irrelevant and hard to compare apples to apples. And I mean, you can see here, for example, in this allocation pie, there's real estate equity, 17%. Now, Well, if I go to another slide, you'll see real estate 26%, and then private equity 30, and here it's private company at 47. Now, what is what? Is real estate and private equity the same thing? Do people put their private companies under private equity? And these are huge communities that share survey data about how people allocate their wealth, and yet it's really hard to learn practical understandings from this. Like this is 60% real estate and alternative investments, which is another asset. Like, so this sort of got me thinking about asset classes, asset allocation. And obviously, when we're thinking about Vyzer, like how do we set our own asset classes? And we also see a lot of mess when it comes to how we see people allocating their wealth. And I thought it'd be really interesting or important to set the foundation of these calls moving forward at the basic level of what we're investing in. That usually means like, what is an asset class and what is asset allocation? And this is sort of like the way we see it at Vyzer. And obviously we're very skewed towards privates, specifically private equity. And you see like our pies are big. And the reason I'm presenting it this way is this is kind of fundamentally how I personally look at asset allocation, asset classes, and how I thought it'd be interesting to share it and get your all's input on it. Mike, before I dive into that, you wanted to talk about something specific across what we're seeing here on these other slides?
Well, I think and we'll get to what you have put together. And I think what it is it's a framework to think about. Because when you look at these slides, some of them look quite differently, but if they're using different terminology or they're pulling from a different sample size, it may not mean that much. Like when I look at this one, for me, private company, real estate equity, and public company equity, those are all sort of in that same equity bucket. And so when you look to these different ones, they're not that far off, depending on where you're at. But it's something to just kind of figure out a framework that you can look at these that works for you. Because, like Litan and I were talking about, we know people that they'll say, oh, I want to have a 60-40 portfolio, and that's the public markets, between stocks and bonds. But then they don't consider their private company that they own, or, the real estate that they own, or the LP investments as anything else. And it's like that gets in there. So it's like, okay, you're balancing out this 60-40 portfolio, but if that's half of your portfolio is public and the other half is private, and then you've got the private market stuff is all equity based, you don't have a 60-40 portfolio. You've got, something that is, what would that be? 40% of 50. So you got an 80-20,
right?
Is what you,
yeah. And there's this sort of, there's this
equities versus bonds.
Yeah. And there's this, I don't know if it has a name for it, but there's this sort of really rule of thumb, I'd say mass market relevant rule, which is if you want to understand what your allocation to stocks should be, you do 130 minus your age, right? So if you're 45, you want 85% in stocks and 15% in bonds. If you're 70, you want 60. And this goes obviously from a, risk mitigation standpoint. And obviously this is extremely rough, but even looking at this, to Mike's point, stocks and bonds, what if you have a bunch of other stuff in your portfolio? Like, how does that reference into this? And how do you think about that? And so that's like what got me thinking about a whole different way to think, or framework to think about allocating our asset classes. And so I split the world into 3 buckets, high level. Okay. And this isn't rocket science, but it is important to emphasize. There are 3 types of investments on the highest level. There's equities, there's bonds, and there's cash. And an important point, which I've seen a lot of people, I think, mistakenly approach, which is all cash is liquid, but not everything liquid is cash. Because people say, but I have $2 million in a portfolio, and that's what I'm going to use for my emergency fund. And like, all right, but that's fine, it's liquid, but what happens if the market tanks 40%? Is it still considered the same? Like, would you still consider it cash? And so I put cash, like strictly cash, in the bucket of cash, and then equities and debt in a different one. And I think it's really important to emphasize what an equity and what a debt is. All right. So if you look at returns, equities typically have an upside potential, right? You buy a house, it's equity, or you buy a publicly traded stock, that's an equity. And there's value add potential, right? And typically debt, it's fixed return. You give someone a loan, that's debt. You buy a bond, that's debt. These things have fixed returns, fixed yields. And that's like one difference between equity and debt. And then you have the risk. Equity is typically higher risk, debt is lower, and hence the return is linked to that. Cash flow, when you're investing in equity, it's usually variable. It's not something you can really plan on. You can expect it, but not like in debt where it's usually a fixed cash flow from that debt asset. and a time horizon. And again, there's obviously outliers to this, right? But this is the fundamentals of equity and debt. And I know this sounds really simple, but it becomes more complex in a second. But for equity, it's usually a long play, and debt is a defined term. And the simplest way to look at this is if I give someone a loan, there's a term, or you invest in a debt fund, or you invest in a bond. These are typically predefined on time horizon. And equity is usually a lot more uncertain and longer. Now, this is the equity and debt. Now, obviously, and I mentioned this as I was explaining this, I look at this as each of these now splits into privates or public positions. So every equity.
Before you go there, Litan, I just want to make a comment on risk. I mean, This is like the basic risk, but there's also the risk if you have only debt that you lose to inflation over time. But from a retirement portfolio, that might be actually riskier in a certain sense, because there's a risk that you fall behind inflation. Right now, S&P 500 is up over 100% the last 7 years. If you were in bonds, you would not be nearly as well off. And that'd be a big risk to your retirement plan and happiness, I think. It's a different kind of risk.
Even you're right. But also within debt, there's vast differences of how much risk you're taking. I have things in my portfolio that's like venture debt that I'm getting paid 17% on, and I've got stuff in a money market that I'm getting 3.8 or 4% on. And the risk profile in those two investments is vastly different, and the time horizon is very different. One I have very liquid, I can get a hold of it right away. The other one, it's like it's going to get returned in a certain time frame, but I don't know exactly when. And so that's one of these things that's sort of hard to go with. The other thing on this slide, Litan, that I would say is under equity, your time horizon, it is longer and uncertain with that. But if you are in the public markets, that actually is more certain and you've got more control, versus if you're in the private markets, it's on that side of things. Things get a little squishy, but this is a nice framework to kind of think about the two with it. But there are variations within all of these.
Right. But I think the vast majority of people who invest in equities do it for the long term. If you're doing it for the short term, you're a day trader. And then it's by definition, you're going to make money if you hold it long term. Usually, if you're like a common investor, as opposed to short term, right? That's just, I think, but I think the more important part is the uncertainty of the term, right? It's like, you don't know. You might want to hold it long term, you might want to hold it.
Yeah, I mean, the NASDAQ took 15 years to come back from their high in was it 99, 2000? Yeah. So that's very uncertain in terms of time horizon. That was just to break even. And so
then as I mentioned, and then each of these, I think, splits into public and private positions. And then each of these have their own integral parameters, right? There's liquidity, and it's obviously a spectrum, but publics tend to be much more liquid than private investments. Yeah, you can say, well, if I'm a private debt fund that I have quarterly redemption periods, it's more liquid than a private equity investment that's in a 7-year lock-in. But still, publics by definition are much more liquid than private investments. And again, each of these sort of trade-offs has the premium they pay you for the illiquidity. So the returns are usually, or should be, higher because the premium you're taking for this illiquidity. Same goes for transparency, right? Public markets are much more transparent because all the data is out there in the open, versus privates where there's no opacity. Return drivers, publics are much more market-driven, supply and demand, which is a good and bad thing. And privates are much more driven by the person or the operator, the company you're invested in, and not as much as the market. Obviously, both affect it, but they aren't the main driver. And access, of course, publics is broad access by definition, and privates tend to be much more limited with accredited, qualified purchasers or whatever, or even understanding how to reach good opportunities. So just to recap this, if I look at asset classes, everything starts by equities, debt, and cash, and then the equities and debt are split out into privates and publics. And then I think when you do that, you can then take any asset and put it in those buckets, and not just for the sake of doing it, but in order to compare apples to apples and to understand what we're investing in, what premiums I should demand to get or I should look to achieve when I allocate capital into these different asset classes, right? Because, for example, if I'm investing in real estate, which I think is a great example because people say they invest in real estate, but it's so much broader than that, because I might be investing in the real estate through public equities, which let's just say REITs. Someone else might be investing in real estate by flipping homes, which is private equity, obviously. And then when you take up all the real estate you have on the underlying assets, then you can really understand what your exposure is and look if your trade-offs for the liquidity and risk and return make sense. So that's sort of like the overview of like how we see the asset class definitions and buckets. Before I go into sort of an example, any questions on this? Any remarks, Stephen, other than sort of like your good comment there? Does it make sense? Is it totally whack? Like, feel free to knock us down. All right, so I'll dive into an example of just a portfolio. Let's just say this is all the red over here is equity, the blue is debt, and then cash. And so cash, an example for cash is obviously pretty straightforward, checking account, savings, money market. And the reason we do this is we want the stability of cash, the optionality, which I think in this day and age, when there's so much uncertainty in the markets and there are probably going to be a lot of opportunities coming up, we want the optionality, and that's why we might have a lot of cash and emergency runway, of course. And so, but this is pure cash. This is not, liquid assets that could be cash. This is just cash accounts. Then we'll go into private equity. And private equity, examples of that could be rental properties, private equity, like proper private equity growth type investments, VC, having my own business that I operate. Those are all under the private equity. And obviously I expect to have a higher return profile or some other aspect based on these different dynamics that give me a trade-off in comparison to the public equity side of this pie chart. And the public equity will be traded stocks, REITs, crypto. Crypto, I'm sure, is a big conversation we can have because crypto could be put in different buckets. But if we go through the framework I just showed you guys, if you think about crypto is liquid. It's transparent. Like if I go up here, it's equity. There could be some debt, like that's a very on the sidelines, but predominantly equity. And then it's liquid, it's transparent, it's driven by the market, it's broad access. So if you look at crypto, it is a public equity holding. Some people might argue this is cash. Well, I don't know if there's enough utility in crypto to use it as cash, fine. I don't think we're at that stage yet. So I'd still put this in public equities, but we can have that conversation.
Well, the only thing, Litan, that I think there's more and more stable coins, and that's crypto that is cash. And that I think I would definitely put in as actual cash. It's liquid, it's stable, it's cash. If you're talking Bitcoin or Ethereum, then I would agree completely. It's liquid. And it's public, but it's definitely not because it's going to vary a lot. And it's, that variability to it, whether that's up or down, takes it away from that. But I do think that stable coins are becoming more of a thing and we'll see them more. But and in my mind, that's cash. Otherwise,
I like it, Mike, but let me ask you a question. Coin like USDT or something that's the equivalent of the dollar. So it's not crypto.
It is. That's crypto. I mean, it's how you're holding cash. You've handed somebody $1 and they've given you $1 worth of a stable coin, which will in the future more so, but even now will allow you to make payments across countries, hold things, stuff like that. But I think that stable coins are going to become more and more useful and valuable and used on a regular basis. And I think that we'll start doing things like that more often. But we'll see. But that's my opinion. And I think in a lot of countries, if you're in Rwanda, a lot of times you'll get paid in the local currency, but you don't trust that currency. And so you're not worried about as much as of like your dollar going down. The dollar is so much more stable for them. So they're changing into things like the stable coins. But that was my crypto cash. But most that we think of like Bitcoin or Ethereum or Solana, those are, in my opinion, too, public equities.
Fair enough. I mean, I'd still put that as a currency once you look at it that way, and then you put it in the same bucket as just holding foreign currency or not, but not that important. I mean, it's a fair point. And then we obviously have the private side of it, or the debt side of it. We have private debt. Private debt can be hard money lending, it could be investing in a debt fund, litigation financing, anything that's under the debt, obviously because it's lower risk, usually lower returns. It's private, so you should expect higher returns in the public side of it, just because of the premium you should be paid for that. And then we have obviously public debt. And so when you look at a portfolio and you put it into these buckets, I just feel like the framework helps easier to compare between different portfolios, and it reduces the amount of subjectivity to asset allocation in my mind. And this is how I look at it. And I just thought it'd be interesting to share with you all to, number one, give you my perspective, and if you have any other thoughts on this. Because like one question that might come up is when you look at how do you define gold? Where would you guys think gold fits? Anyone? Don't be shy.
I'll call it cash. It's easy to sell.
Is it?
Liquid. I think not that you get your money back, but you can sell to somebody, but they charge you a premium to go and premium to leave. So
yeah, I wouldn't call it cash. I would say that it is, if it's an ETF and you've got it on an exchange, well, then I would put it into public equity. And if you have a gold bar in a vault or, at home, then I would put that into private equity. But either way, I would call gold equity. How about you, Litan?
Boris, wait, what did you think, Boris? You were about to say something.
So I'm having trouble with this conversation in general because to me, this seems very hypothetical and very surface level and is not digging deep into anything. For me, you have to define what are you talking about when you talk about gold? Are we talking about hard assets, real gold bars, coins, whatever? Or are we talking about paper? An ETF is not gold, not in my view. Okay. It's a completely different animal. Now, I own both, plenty of them, and I use them for different purposes. My gold bars are insurance against chaos in the world. So, pardon?
And yeah, that's a great thing. Where do you consider them in your portfolio, Boris? Well, I agree with you. They're very different ETF versus
yeah. That's what I'm getting to. So I have different portfolios for different goals and different purposes. So I have a safe and secure portfolio. That is my chaos portfolio. It is all cash, all liquid, capital preservation focused. It never loses a dime. If it does, I'm going to have a real problem because something's going on in the world that we didn't expect. That's where I would put hard assets like gold, silver, same thing. Okay. Now, that being said, we all know gold and silver can go up and can go down. That's where the paper markets come into play. So in my speculation portfolio, I hedge out all my risk. And so I use ETFs and puts and options to hedge out risk in my portfolio. So that's why this conversation is kind of difficult for me because we're putting things into buckets that don't fit naturally for me. Does that make sense? Because I build portfolios based on a purpose and a goal. I know my entry before my exit. I have a purpose that I'm trying to achieve with every trade. There's no discussion we're having here about things like capital rotation. So, if somebody believes that the passive approach to investing, low cost, passive indexing, no active management is the way to go, good luck to you. It's okay. It's just not what I do. And it's not what's working in this market for sure, right? We've lived through a unique period of time, in my view, right? The last 42 years, let's take out from 2022 onwards, but the 40 years prior to 2022 has been a very unusual period in history. It's been a period that's had lower and lower and lower interest rates, which has driven liquidity and driven equity markets. And a lot of the things that we've all benefited from and experienced came from that. That's why the passive trade exists today. It's no longer valid. It hasn't been valid for 2 years. Look at a 60-40 portfolio. People lost their shirt if that's what they had. So what's working today is a completely different model because the world has changed. Nobody's adapting to that conversation. So look, I'm not complaining. My portfolios have done 200+% this past year. So I'm totally fine. But I don't do those types of investing. I follow capital because capital is always looking for a home. I don't allocate money based on arbitrary asset classes or some historical performance.
Would you say that most people, Boris?
No, most people lose money in the markets and they lose money investing. So I don't know. I don't know what to say about that. Like the vast majority of the investing world statistically shows if you take the best investors in the world, right? 68% of them, okay, let me rephrase that. 68% of the time, the best investors of the world are right. If you took out the top 5% of those, it's less than 50-50. It means you could flip a coin otherwise. So
I think one of the reasons I think is, first of all, I agree. Most people make really bad decisions, but also because it's because if you ask someone 15, 20 years ago how to allocate wealth, it'll always be some sort of percentage between stocks and bonds. Right? A common.
Can I say
I don't know if I agree with that.
Yeah, go ahead.
Litan, I wouldn't agree with that.
Okay.
I completely agree with Boris. Here's where I come from, right? If I were in my 20s, I have a different perspective to life and wealth as compared to somebody who's in his 60s. It's like telling a football player to go play basketball. They're built differently. This is how they are. I think it's a very personal question. Where are you in your life with regards to your family, your inheritance, and all the other stuff? He's right. Capital should follow, money should follow where the capital is needed, irrelevant of the class. Some people are comfortable putting 100% of their money in private equity versus some people who want to have diversification. It's just a matter of choice.
That's exactly my point. I agree with both of you. I just think that when you go down, I was just at a post-exit founder event a couple of days ago, speaking with like founders who sold companies, just like networking, and then the conversation that come up is like, who do you invest with in private equity? And then, well, what do you mean? What do you define private equity? Or how much do you allocate to real estate? I'm just saying, even in a basic conversation, how do you answer that question, Boris? You probably say it doesn't matter, just buy an ETF.
You can't, right? Because everybody is different.
No, but even with the definition of what does that mean to invest in real estate or private equity? If you're saying it doesn't matter, so then you can't answer the question, right?
I think what matters to me is it an investment I'm interested in right now? For example, I love real estate, but I think it's a shitty investment right now. Just my opinion. I could be wrong.
Any kind of real estate?
I would say for the most part, most real estate today is well overvalued. I'm looking for asymmetric opportunities when I'm investing. I'm not looking for opportunities that are overpriced. Okay. I don't know who would be attracted to buying bonds today. Some people, I guess, are. I have no interest in bonds. I have no allocation to it.
Yeah, but sorry to interrupt, but Boris, you're looking at a very subject, like very what Boris is interested in. I'm not asking what Boris is interested in from an investing standpoint.
No, but let me answer the question you're posing, because what I'm interested in is where the capital is going. That's my point. I don't care what the allocation is going to look like. I only worry about where is capital going. If capital is going into precious metals, therefore I'm in precious metals. Whether I like precious metals.
Yeah, no, I'm just asking, how much is Boris allocated to private equity?
Private equity? I would say probably about 25-30% max.
Okay, what's private equity in your mind?
Private companies, period. I own private companies. Some of them are in real estate related businesses, not necessarily real estate ownership, RV parks, things of that nature. I don't consider that traditional real estate.
So, but you understand that's it. You understand? You just answered me, and you just said, "Well, somebody define real estate. That's not real estate." I'm just saying it makes it hard to understand and learn from other people and how they're investing without understanding those fundamentals. That's all I mean. Understanding conversation.
That's what I'm trying to point out. The fundamental that matters to me is where's the capital flowing. I'm not interested in real estate as an asset class, but there are pockets of real estate that have interest for me because of the kind of cash flow I can generate and the types of opportunities that fit. I'll give you an example, an RV park, a self-storage facility, not necessarily a traditional type of a real estate investment, but I find there's value in those. Now, whether I do that in the public markets or the private markets, for me, there has to be an exceptionally high illiquidity premium that I'm getting for the private markets. Otherwise, I have no interest in it. Because I can usually find something in the public
Shahzad, you were about to say something as well, Shahzad, around that?
No, I wasn't.
Oh, okay. I mean, I first of all, I appreciate Boris, giving that argument. That's a really important and interesting perspective. I was just bringing this sort of approach where, and I understand how you invest. My issue has always been around the conversation around investing. And what you're saying basically is that if someone asks you like how much you allocate to a specific asset class, you won't really answer the question. You'll just say, well, it depends. It doesn't really matter how I'm investing in the asset class. It's important what your objectives you want to achieve are. Correct?
That's right. And I can answer it in the context of right now, but I can't answer it in the context of 6 months from now because I don't know where the capital will be in 6 months.
No, that's fair enough.
Here's the thing, Laura. Some people, what they decide is they want to sort of like have a structured portfolio where they're going to have certain amounts in different things. Or you're somebody who is beyond that and you feel comfortable having a very flexible portfolio that just decides, where the capital is flowing and then follow it. So if you end up 95% in a certain asset class or a type of thing, you're fine with that. And that's one of those things like you've gone beyond to where you're not caring what that looks like. What Litan and I are trying to do is sort of put a framework together so a lot of people can look at, what is a way to look and to see what other people are doing. Like back to the slides that Litan had, where you look at 4 different large groups with millions to billions of dollars represented, and it looks as though they're investing very differently. And maybe they are, maybe they're not, but it's a way to kind of classify that. Because you said, okay, I'm not invested in, like, you're like, okay, I've got 25 to 30% private equity. But then in our mind, real estate, whether that is a house or that's a mobile home park or self-storage, that in my mind is also private equity because it's a private market, and it's equity that you have. And so it's just a different way to think about that because there are different general risk reward profiles. But I agree with you, within those big classes, there's vast differences on what it looks like. Even it's like an apartment complex it's going to be private equity, but I can have that for three very different reasons. It might be a development play. So that's going to be no cash, no depreciation, so no tax benefits. And it's going to be a high appreciation play. It might be something where I'm buying an existing value add, where I'm going to get probably some cash flow, some depreciation, and some appreciation. Or it might be a coupon clipping type thing. It's a fully stabilized deal. And I'm not really expecting much appreciation. I'm just expecting a lot of cash flow and then some depreciation. So within each of these, there's wide differences, and you're putting different options in for different reasons. But we're trying to give people this overall structural framework of how to look at a portfolio and to think about creating something to fit what their goals are. But you're right, there's many layers more than this. This is the outer framework, and you're talking about 3 levels deep.
So let me suggest something, because if that's what you're looking for, let me describe it for you, because I don't think you have a clear picture of how I operate anyway. But I developed a process around this when I was in the financial advisory business years and years ago. I haven't been in that space for forever, but it's called a balanced barbell strategy. And so you have 4 buckets. You have a safe and secure bucket, which is generally about 10% of the assets. You have a speculative bucket, which is another 10% of the assets. And then you have what's called an all-weather portfolio, which is the foundation. And then you have what's called a dividend portfolio. And that's it, those 4 buckets. And so there's certain rules around how this operates in my mind that might be useful for people to know. So first of all, you never have more than 50% in private investments or illiquid investments in any one of those buckets, regardless of which bucket you're in. So 50% liquidity or more in any bucket. Second rule is safe and secure bucket and the speculative bucket never can grow beyond 25% each, which would mean that would be 50% of your portfolio is exposed to both ends of the barbell. And then the dividend versus the all-weather portfolio is broken down based on how much income you need. Do you need that income to be flowing to you? Or are you in retirement phase? You're drawing down at capital, or you don't need the income? And that's how the larger, holistic view of how I manage things works. But my personal investing, where I spend most of my time, is within the allocation of, in my case, it's 25% speculative. I don't go any more than that. And I manage the 25% speculative. I don't worry about the rest. My safe and secure is always safe and secure. It's always going to be the ballast that holds, my portfolio together. The dividend and the capital appreciation, I usually use third-party managers for that. And I have a very specific mandate that I give to them around what I expect in terms of returns and risk profile. And that's it. And then I manage the speculative myself. That's how I do it with four buckets.
So Boris, thanks for that rundown, and I really appreciate you chiming in, giving your input. We're at time here. Well, I just want to sum it up, guys. This is the first call. I really appreciate the back and forth. It's helpful. We're just sharing our perspective, and obviously there's a tons of perspectives out there, and so it's healthy conversation. We're gonna have another conversation next week, same time, same place. So we're gonna talk about the tax optimization or optimizing for taxes more from a strategic standpoint. Still staying high level. I want these first few calls to be more, setting the grounds for further deeper conversations around tactics. So, I'm going to send out this recording anyway, and we can obviously touch base offline, all of us. If you have any questions or input or feedback, I'd love to receive it. And we'll be in touch next week. Thank you so much for joining.
Thank you.